Okay, guys, so good evening, everyone. And my name is Maurya Hanspal. And in this session, I'm going to talking about going advanced in valuation and particularly talking about the new trend in the market that is IPOs or the initial public offerings for college Dekho. The initial IPO trend or the IPO frenzy that we can see in market is quite prevalent nowadays. But the majority of the companies that were being listed in the stock exchange comprised of the loss making companies, as we all know. As we popularly call them as the new age tech startups or digital startups. But how did these loss making companies were able to get listed on the stock exchange, be it your Sensex or Nifty? How did SEBI or the Security Exchange Board of India allow these loss making companies to get listed on stock exchange? Completely agreed. These companies have no profits. These companies have negative cash flows. But how did SEBI was justified to get these companies listed on stock exchange? These companies can be listed on stock exchange, but how? These companies have to prove themselves, have to prove SEBI, have to prove investors, have to prove the various other market capitalist ventures, the venture capitalist funds or the private equities that these companies would be performing well in future. These companies would be able to turn around their losses into profitability. These companies would be able to convert the negative cash flows into positive cash flows. They have to justify in terms of all these things. Why these companies have negative cash flows? These companies have negative cash flows because of the huge amount of capital expenditure these companies are making, capex. And because of this capex, the free cash flows of the companies are negative. So ultimately, these loss-making startup companies have to justify SEBI, the venture capitalist firms, and various other investors as well, that they would be getting a huge money for their investment right now. Because a large chunk of money is being used for the purpose of capex at this present time. And in future time, at a terminal value, be it from 5 years from now or 10 years from now, these people would be getting huge return. And once everyone is satisfied, these companies can be listed, provided they can project a foreseeable future. There would be a certain point or there would be a certain terminal value or an year when these companies would be profitable. These companies would be making positive cash flows and they would be able to justify their huge capex, their capex in millions and dollars, right? But there is a change in the procedure, in the allocation process. When a profit making companies get listed on stock exchange, 50% of the book is allocated towards QIBs. 35% is allocated towards the retail individual investors and 15% is allocated towards the high net worth individual investors. But when a loss making company gets listed, 70% of the book is allocated towards QIB and remaining 15% each is allocated towards the RIIs and the HNIs. Maybe to protect us or maybe to protect the people who do not have a large sum of money to invest in market. Our country, India, it witnessed around 63 IPOs in the year of 2021 that raised 1.18 lakh crores from the market. And that was a huge chunk of money. But how can we forget the year of 2007 and 2010 when 108 IPOs and 66 IPOs were raised from the markets? Agreed completely. The amount of money that was raised at that time from the market was far less as compared to the year of 2021. But why again these IPOs come at the time of a bull run? When the bulls are heavy than the bears. That is, when the demand of the stocks is more than the supply of the stocks. Or when the market is rising. When the market is in a boom phase. Why? Is it just to command a higher valuation? Because what happens in valuation? When the market is rising, when the market is on a boom, these companies can command a higher valuation because of the premium for optimism. But when the market is in a phase of recession, these IPOs don't come. And even if these IPOs come, they would maybe come in a phase of consolidation when the market is in a sideward direction. At that time, they may have a discounted value. That thing we need to consider. The same thing happened in the past as well. Let's go back to history. We had the dot-com bubble in 2000, and before that, the market was on a boom. At that time, those tech companies were not fundamentally strong. Be it your petswan.com, be it your webcam, any other companies, these companies weren't fundamentally strong. And the market crashed in 2000. And again, the market kind of witnessed a bull run till 2008. Again, in 2008, all the expectations were broken when we had the housing bubble. The real estate prices crashed and the interest rates grew up. Again, the market went on the bull run. Again, in 2013, we had the taper tantrum by the Fed. When the interest rate rose and there was huge capital outflows from the market. Again, are we in the same phase right now? Because again, we are in the phase of optimism, and again, the Fed has announced to raise the rates of interest by 3 times in the year of 2022. So that's just the future. Because history is the future itself, yet entered into through another gate, which I believe in. A lot of people all over the world, they have believed in some of the stages which these markets go through in a cyclical nature. There is a displacement phase when everything is so cheap in the market. Cheap in the sense at a low price, and people can buy those stocks when the price is low. They start buying the stock and the demand for stock increases and the market, it begins to rise. That's a boom period. Then people become over-optimism. This over-optimism, it drives excessive valuations, irrational exuberances in the market. Companies with no fundamentals. Being optimistic is completely correct. We should be optimistic because the companies are coming out of the phase of COVID and still they're trying to maintain their stand in this wave of Omicron as well. They're trying to become net debt free. Their earnings are good. Their earnings are good. Their cash flows are good. The PLI scheme is there on various other sectors to support industries. Our economy is on a growth trajectory. We have the China plus one strategy as well, because currently China is into a technical crackdown and all the investments from China are coming into the emerging economies and especially India. But up till when? If the Indian market tends to be overvalued, which it is, all the investments will go back to China because at this time the market is undervalued and people like to buy cheap stocks. Again, the market would go down. Leave all this. We have a good GST collection numbers, and good numbers for tax collections also. It is good. But being optimistic is different from being over-optimistic. Again, this over-optimism, it drives excessive valuations, irrational exuberations. There is a euphoria in the market. And what we call it in terms of core investment banking, kicks in the pants explanation when the market is overvalued. And at some time, the profit taking happens. People start to sell their shares. And then there is some bad news in the market and market starts to fall. That's panic selling. And at some time, the market mean reverses. That is, market values all the stocks at a fair value. And that we call in terms of investment banking as sitting on the gold mine hypothesis. Everything is fairly valued. The mean reversion happened and everything came on the track once again. And then again, the same cycle repeats. Excessive valuation, the market on a boom, and then it crashes. The same cyclical nature of the market. Again, because people get fearful when the market is reaching great heights. Let's imagine a situation where people are not fearful and they continue buying the stocks. Do you really think the market would crash that time or would correct that time? Still it would. Because there are some other factors. You have the interest rates, you have various other instruments in the market except equity as well. And those cryptocurrencies are everyone's favorite now. Right? So coming back to the topic of IPOs. Even the top investment bankers and analysts, they're not afraid to admit that those traditional measures of valuation are not working for these loss-making companies. Are not working. So some methods might work, but not all the methods are working. So in this session, I would be covering the traditional methods in very short in the next 10 to 15 minutes that we have for this session. And in the next sessions that we have, I'll be talking about some of the new metrics which you could use to analyze the stock markets or IPOs in detail. And I would also be talking about my own metrics which are available nowhere on Google or any other social media websites. That's a part of my own book and I have a copyright for that. And if anyone tries to use that kind of metrics in future, so beware, because those metrics are in my name. Okay, so that's one thing I want to discuss. So like coming back to the topic. So talking about the first method, the people who have a great knowledge on valuation and finance, they know this method of DCF. That is the discounted cash flow method. In this method, we need to project a positive cash flows in future and discount it at a present value to get the present value from the future cash flows. But since these loss-making companies have no cash flows, neither they cannot predict a positive cash flows in future, then how can we use this method of DCF, right? So coming to the like basically the method number 2, the method of relative valuation. These startup or the loss-making companies that are coming in the market, they have no structured equivalent companies listed on the stock exchange. So how can you compare your loss-making startup with other companies? Because a similar kind of company is not available on the index. Sensex में नहीं है and Nifty में नहीं है, तुम कहीं भी नहीं है. How can you compare? Again, you cannot use the EPS or the price to earnings ratio because these companies have negative profitability. They have losses. So these ratios again cannot be used. But one measure that can be used, it can be to EV to EBITDA ratio, because it excludes the impact of all the interest charges, tax, and the non-cash expenses of depreciation and amortization. So usko exclude karke, most of these companies have a profitability. So EV to EBITDA ratio we can use to value the company. Talking about the revenue multiples, we have price to sales, we have EV to sales, and that's an amazing kind of metric which these companies are using to value themselves and other startups as well. Price to sales and revenue to sales, or they have EV to sales. Valuing your company on the basis of the sales that you make is one such metric you can. Because if your business is not having sales, it's not a business. With sales, you can command a price. That's the fact. PB ratio. Price to book ratio can be used for those companies which are asset intensive, who have a book value, who have some assets. But these ITs or tech companies, they might have assets, but the quantum of assets would be far less. You can use, but this ratio might not give you a clear projection because these companies have the lesser quantum of assets. ROE, the return on equity. Again, you do not have the profitability. How can you use this measure? Again, the goodwill to assets. This measure can be used because ultimately these startups are commanding goodwill from the public. But again, assets, these companies have a lesser quantum of assets. So again, a company which is asset intensive, that company can use this method. But it doesn't work for the IT startups. Expected reinvestment. It is nothing but at what rate we are reinvesting or at what rate we can get back our investment from the market. So basically, when we try to project a sustainable growth rate in future, we tend to use a formula, and that was suggested by Warren Buffett. Okay. And that formula was nothing but your ROE, that is the return on equity, into your retention ratio. Again, these companies have a negative ROE. Again, you cannot use this formula. But one formula was suggested by Ashwath Damodaram in his book of investment banking. He's a great teacher, a professor, and a guide in terms of investment banking. He said, like, use a formula that is basically operating profit divided by your sales to capital ratio. So this ratio can be used for loss-making companies as suggested by him. So he basically meant that how much sales these loss-making companies are able to produce on the basis of the per dollar capital that is invested into them. So that measure can be a good measure. Now coming back to venture capital method, it's purely a startup method. You need to project a terminal value, that is a time when your company can make some profitability or cash flows, and then discount it at a target rate of return, right? Discount your future value into present value, like when we say it in the most simpler sense. Okay. But this method is used by the venture capitalists. And I have already talked about the venture capital method in my previous session of like YouTube Live with College Dekho. So the whole method is available on that recording. Okay. So you people can go back and watch this method. Talking about the economic value added, EVA. Again, this formula of like, I'll just erase it out or I'll just take a new sheet. Again, economic value added, it is showing a measure of the economic profit. That is your investment able to earn money. And the profit for this is basically your NOPAT, like the formula, minus your invested capital. That is how much capital you have invested into your WACC. And WACC is nothing but the weighted average cost of capital. That how much return you're going to get from your investments, be it equity, be it debt, be it preference shares. These companies are having a negative NOPAT. They have capital, but this return is negative as for now. Whole of this answer would come out to be negative, and you cannot calculate EVA for these companies as well. Ultimately, you cannot calculate the market value added for these companies as well. Because market value added, as we call it as MVA, is the discounted version of EVA. You have to discount it by a certain rate. When this value is coming out to be negative, how can we calculate MVA? That is the market value added. Again, this measure cannot be used. You can use the Berkeley approach and the first Chicago approach, because these methods are meant particularly for startups only and taught in foreign universities only. And to be like, I would say this in a very sad tone, that these methods are not taught in India like so much. Okay, so this method is basically a method for valuing the startups, which is taught in universities outside India, in startup schools and all that. So Berkeley approach and Chicago approach, it tends to take a certain factors and assigns certain kind of weightage to those factors. And then you take the sum of this. And that helps you to calculate at least that how much return you are getting from that particular factor. Okay, so we'll talk about this method later in my subsequent sessions. Exit valuation, in the method of exit valuation, so what these companies are doing, in the method of exit valuation, the venture capitalists are trying to predict the company's future. That they are saying after 10 years from now or 15 years from now, we'll exit from this company, either through an IPO or by selling our shares back to like the promoters of the company and get our money. So in exit valuation, they're trying to predict a terminal value, that is at a time when these venture capitalists or PE funds can exit from the business and earn their money. Because ultimately they have taken huge risk while investing into these companies. A higher risk and a higher return formula they have undertaken. Then you have the scorecard and the option models. So scorecard is basically, it lists down a certain range of factors which are important and critical for the company to grow. Maybe your investment, your like techniques for development of the products, your innovation and development strategies. So all these things are taken into account and weighted all together. But what do we do in the option models? In the option models, you have a chance or you have an option to delay your investment. If you think the company is a completely loss-making company as of now, and the company cannot earn, and you think that if you are investing your money right now, you might be still into losses for up to like 5 years from now or 6 years from now. So instead of investing right now, you have an option to invest maybe like 5 years from now, when at least the company starts to make a certain kind of like profitability or starts to reverse. So जहां से तुमको लगे the company had started to reverse, and that is an opportunity, start to buy them. And that is the option model. Because abhi the company is into losses and you do not know till what time the company would be into losses. If you think 5 years me you are, after 5 years in 2027, you think like basically a turning point has come for the company. Like the revenue has started to rise and the profitability, I mean like the losses have started to reduce. मतलब कि losses profitability में convert नहीं हुए हैं, but the losses have started to reduce. At that time you can buy those companies, and that would be the right time to buy those companies, because at that time the companies would be at a very undervalued price. And when the company would change their profitability, be profitable, and have positive cash flows, these companies will be valued at a very high price in the future, and that will make you earn money. That's it. Okay. So these were like some of the traditional models. And out of these models, like some of the things worked and some of the things did not work, right? Like EV to EBITDA work, price to sales work, EV to sales work. You had the new ratio by Ashwath Damodharamji. You had the venture capital method, Bokus approach, first Chicago, the exit valuation, scorecard, and option models. All these techniques worked. Okay. So let's keep this session short and crisp so that you people have the understanding of the various other models. So all these models जो मैंने आज बोले, DCF and relative valuation and revenue multiples, we have done all these models practically hands-on experience on the YouTube live sessions only. And those sessions are available on my previous like sessions on valuation on the College Dekho live channel. Okay, those sessions are available. We have literally solved it and calculated on the whiteboard. एक sum हमने किया है calculate on these things कि practically कैसे करते हैं. Okay, all the valuation measures have been talked in the previous sessions, but this session was completely on the introduction of IPOs में क्या है. ठीक है, तो अभी हमको ये चीजें like at least we know कि कौन से मतलब कि methods we can use and कौन से methods we cannot use. In the next class, I would be talking about some new metrics for these companies, some new metrics to value these companies. Because the valuation of the companies had started to include not only the quantitative numbers, but also the qualitative aspects as well. Because finance, everyone said finance is like all about numbers. But these startup companies or loss-making companies have changed the field of finance. They say finance can be both quantitative as well as qualitative. They've changed the definition of raising money. They've changed the definition of finance because a lot of qualitative measures are taken into consideration to value these companies. And how to convert these qualitative measures into quantitative measures, a huge number of formulas and calculations are there for that, and we'll talk about it. Okay, so not to worry. So this was all for today. Thank you so much, and I'll see you in the next